Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. So a new set of U.S. tariffs has been set and a new trade deal deadline has been issued. In one example, President Trump will now impose a 25% tariff on goods from both Japan and South Korea beginning August 1st. And Trump also imposed 36% tariffs on goods from Thailand and Cambodia, also effective August 1st. Interestingly, Trump said later the new deadline is not 100% firm. Even so, the heat on U.S. trading partners has been turned up, especially now that the current 90-day reprieve from those reciprocal duties is set to expire on Wednesday. For a closer look, I'm joined now by Ahmed Riesco. He is the CIO at Insignio, and Ahmed joins us from Miami. Ahmed, thank you for making time to chat with me. So today we get a new set of U.S. tariffs and a new trade deal deadline. Markets reacted adversely. That's really not a surprise. Does it create a lot more in the way of uncertainty in your view?
I think it does in the near term. However, I don't think it changes the longer term narrative, which is that, Trump saw and the members of his staff saw the uncertainty, the market sell off post-Liberation Day, and I don't think they want to return to that. So, I mean, we sort of expected this. This is sort of, if you look at the Trump sort of playbook, this is par for the course. I think if the market really thought that these tariffs that were announced today were going to stick, I think the market would be down a lot more sharply than it is today. So I think, sure, this causes some uncertainty in the short term, but I don't think it changes the overall narrative that, deals will get done and that the effective tariff rate in the United States will settle somewhere between 10 and 15%, right? It's hard to say exactly where, but if it does, along that range, I think we'll be okay. I think the markets will be able to digest that.
We heard today from former Fed Governor Kevin Warsh. His name has been floated as the possible successor to Fed Chair Jay Powell. And Warsh told Fox Business today that tariffs are not inflationary and that interest rates should be lower. Do you believe what he's saying in terms of its sincerity, or is he lobbying for the job, do you think?
I think it's probably a little bit of both. I do think that, Trump is sort of negotiating against himself here with Powell, meaning I think Powell probably wants to cut at least one or two insurance cuts. And I think, but at the same time, he wants to preserve the independence of the Fed. So he's less likely to cut because of this political pressure that's being put on Trump. But I do think the Fed has reasons to cut. Inflation has, we are just simply not seeing it in the numbers. And what's happened is that with inflation coming down, the real Fed funds rate has actually gone up quite a bit. So monetary policy is quite restrictive right now. And given where the labor market is, in a sort of weakened state, I think it makes sense for the Fed to cut at least 2 times, possibly 3. Let's just hope, the politics can sort of allow the Fed to do its job.
So do you think that has largely been discounted by the equity market as of now, the idea that we're going to get that many rate cuts from the Fed, and that when they do occur, that there's not going to be a lot in the way of juice that those rate cuts provide the equity market?
Yeah, I think if you were not to get a cut, I think the market would react adversely to that. Right now, the market has discounted roughly 2 more cuts this year, with the first one in September and the next one in December. Now, that has oscillated a bit between 2 and 3 cuts over the last couple of weeks. But surely, if we were to get no Fed rate cuts, which again, it's not our expectation and it's not what we think should happen, I think the market would react negatively to that.
So where are you finding opportunity right now in the stock market?
Well, that's a great question. Nothing really has a lot of conviction. I'm not in the mood to short either equities or treasuries, and I'm certainly not in the mood to buy the dollar. So I'll put it that way. I have sort of low conviction that the equity rally will continue for the year. In fact, we expect it to sort of end somewhere in the mid 6,000s. As long as, our base case of no recession and the effective tariff rate between 10 and 15%, we think the equity market could continue to grind higher. At the same time, that would see the 10-year somewhere around 4.25, so a little bit lower than where it is today. But where we do have higher conviction on is that the dollar should continue to fall throughout the year.
Is there a higher probability that we're going to see a pullback in stocks than, let's say, a grind higher in equities?
Look, these things are impossible to say in the short term. Who knows what the market's going to do from one day to the next? I know we've had a very strong rally here off the April 8 lows. So, some consolidation is, probably healthy and warranted. So this could potentially be, if we have a couple of weeks of uncertainty with the tariffs, this could be the excuse that the market's looking for to pullbacks quite some. But the underlying trend should stay intact.
How are you viewing market opportunities offshore right now?
Well, on the offshore space, we do find some great opportunities. We like, certain countries quite a lot. One country that we're really looking at that we find quite attractive is Argentina. We think the country, has been going through a generational change that's very positive for capital markets, for investors, for private capital in general. We had a strong rally last year. Some of it was given back at the beginning of the year. We think this is a nice opportunity to, if you missed the original wave of that trade, to potentially go back in. So there are some pockets of opportunities outside of the United States. That's one of them.
Are you holding on to a fair amount of cash right now?
No, I would say we're pretty neutral at this point. We had raised cash post-Liberation Day, and then with the market sell-off, I'm not going to say we caught the bottom of it, but we have been able to participate. We were able to deploy some of that cash once we saw that the market had really already priced in a good recession. Remember, markets were down close to 20%, the Nasdaq and some of these other indices. So that's already that's not too far from the median correction during a typical recession.
So the big beautiful bill, as we know, is now law. It adds, if you listen to what the Congressional Budget Office is estimating, about $3.4 trillion over the next decade. The bond market at this point doesn't seem to be very much concerned about that fact. Are you?
Well, look, I'm concerned about the country's long-term fiscal health, and I'm concerned that there's no political will from either party to address it. What I will say is that it looks like the deficit, once you factor in the tariff revenue that's coming in, I think that's a key component of this, which, by the way, tells you also that tariffs are going to be sticky, and tariffs are probably going to be around a lot longer than Trump, because that's revenue coming into the government right now. When you factor in those tariffs, you're looking at a fiscal deficit of roughly 6.5%. Now that's a bad number, but we were expecting somewhere between 7 and 8%. So this is a situation where the news is bad, but it's not as bad as it could have been. And I think this is why you're seeing the bond market largely shrug this off for now.
So what are your expectations for U.S. economic growth for the remainder of the year, let's say? I'm talking to you from Miami. Any indication that I have been receiving lately about the growth in Miami is that the city is doing very well. So talk to me about the broader landscape. How are you seeing overall U.S. economic growth going forward?
Yeah, so, we're expecting U.S. economic growth to sort of take a bit of a down step, but nothing too severe. We're expecting GDP to come in at roughly 1.5%. If you look at current levels, it's looking at around 1%. So we think the second half of the year will look better for growth. 1.5% sounds okay, considering what we were staring down the barrel come April 8th. But keep in mind, U.S. trend level growth is 2%, so it's not enough. It's going to be one of the weaker years for U.S. growth that we've seen in quite some time. So even though that doesn't sound too terrible, it's not great, especially given the debt dynamics.
So how much of that forecast is predicated on the notion that we're going to get a total of 50 basis points in Fed easing this year?
Yeah, that's the base case. If we don't, I think growth will be slower than that. You're seeing a lot of weakness in housing. You're seeing weakness in the labor market. Again, I think if not but for the political pressure that Trump is putting on Powell, I think you would, my guess is, obviously this is a counterfactual, we can't run the simulation, but my guess is that Powell would have already perhaps cut already at least once or at least gearing up to cut here shortly. But I think, like I said, Trump is negotiating against himself by putting this political pressure on Powell.
So there's a possibility, let's put the tariff story aside for a moment, that the Fed is behind the curve, is kind of what you're saying.
I think so, yes. Yeah.
All right, we'll leave it there. Ahmed, thank you so very much. Ahmed Riesco, he is the CIO at Insignio, joining from Miami here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Let's take a closer look at the U.S. tariff story. Earlier today, President Trump imposed new levy rates on U.S. trading partners beginning August 1st. This would include Japan and South Korea. Interestingly, Trump also left the door open for additional negotiations. We got some analysis from Skyler Weinand, the CIO at Regan Capital. He joined Bloomberg TV host Heidi Stroud-Watts and Avril Hong. And Heidi asked the first question about the way in which markets are reacting to this shift in U.S. tariff policy.
Look at the market today. The market's down a little, but U.S. stock market's up 7% for the year. So every day that actually goes by, the volatility from that initial liberation day recedes. And as time goes by, it's just human nature, right? So as time goes by, it has less and less of an effect on the market. And so the market today is pricing in those tariffs that we just saw on the screen, 30 to 40% roughly. And any lower tariff amount would obviously be very beneficial for the Asian stock market.
Scott, a function of how good that U.S. rally looks is also what we've seen with the U.S. dollar, right? If you take that out of the equation, are there better international options?
Yeah, so you can look at Europe for sure, and where PE levels are much lower than the United States, and interest rates have been coming down precipitously. A lot of European countries in the euro have been cutting. So you have this stimulus coming in from lower interest rates. You have a better value in terms of PE. All of those add up to potentially better opportunities in Europe. Looking to Asia, it's a little bit more difficult, right? You have Japanese inflation with Japanese wage deceleration. Market's not doing great. But yeah, it's the decline of the dollar has definitely been beneficial internationally. But as other countries have been cutting interest rates and have lower interest rates, and the U.S. interest rates stay high, especially on the long end, I would anticipate that $97, that 10 to 15% dollar decline that we've seen to reverse.
Why, though? Because we've seen in the past couple of months, the greenback hasn't been benefiting from yield differentials.
Yeah, and part of that was given Liberation Day, given the administration saying, hey, basically your money's no good here. you had section, I think it was 899, that just got stripped out, that was going to potentially penalize foreign investment. So it's just a matter of time before these carry trades set back in and make U.S. Treasuries attractive again and accelerate the value of the dollar. So you are still dealing with the aftershocks of the administration saying, hey, get out of here. That's been receding, and stock market's gone crazy. I think interest rates potentially pulling investors back into U.S. Treasuries will happen. Rates may need to go a little bit higher in order for that to happen, and in order for the dollar to strengthen again.
Yeah, it's interesting because I think you believe that the next move by the Fed might actually be a hike. Yep. What are you watching for that would inform that maybe come September in terms of the aftershocks from U.S. policy into inflation, into growth?
Financial conditions are as easy today as they were 3 years ago. Basically right when the Fed started hiking interest rates. You have the highest stock market cap in the U.S. in history. You have consumer balance sheets flush with cash, U.S. net wealth at $170 trillion, U.S. corporations utilizing the least amount of leverage in history. So you add all that up, and you have a tremendous amount of dry powder for the market to keep going, okay? Look at the most recent jobs report, very, very bullish for continued growth, but inflation's still relatively high. And the U.S. government just passed a $3 trillion deficit bill, totally unnecessary spending. We're not in war currently, hoping that we're going to grow ourselves out of it. So all of these things add up to hypersonic growth and potential inflation that the Fed may have to walk back the 100 basis points it cuts that they put into effect last fall.
Really interesting perspective. Skyler, thank you so much. Skyler Weinand, the CIO of Regan Capital.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.